Good afternoon, everybody. Welcome to High Mount Research Market Insights video. Willie Delwich here. It is Thursday, March 30th, 2023. Hey, everyone. In these Market Insights videos, I'm going to try to not look at everything that we could talk about. There's plenty of that, but kind of focus in on a very narrow topic. Something that's come up in the news over the past week or so, or something that I've been thinking about. So they're going to be shorter, not as comprehensive as the longer portfolio application videos that we'll do on a monthly basis. We'll have one next week after we have the month end and the quarter end data that comes out. But for now, this is a market insights video. And for today, we're going to talk about sentiment and positioning, not from a week by week perspective, but from a long-term perspective. Saw something earlier this week about how cash is the most loved asset class, how stocks are an unloved asset class, and it really got me thinking about where we are from a big picture perspective, and worried that as we look at that short-term data, we can lose the forest for the trees as we look at sentiment and positioning. So let's get into it. The first thing that we want to look at today is this idea of long-term household equity exposure. And you can see here, going back 50 years, this is data from the Fed. It's not a survey data. It's a survey sentiment. It's actual data, actual dollars, numbers that are behind this. On the top, we have the S&P 500. On the bottom, household equity exposure as a percent of total liquid assets. Peaked at the end of 2021. I've talked about this in the past. Just want to set the stage here, and then we'll go through kind of where we are and what I think this means going forward. So peaks similar to what we've seen at the end of 2021. Saw a similar peak heading into what turned out to be the internet bubble that led to a lost decade for stocks. Lots of volatility, lots of sideways action. Go back into the late 60s. Again, saw something similar, peak in household equity exposure, drawdown after that, and stocks went sideways for a decade plus. Again, a little bit up, a little bit down, actually a lot up and a lot down, but at the end of a decade, still pretty much where we were to begin with. Just zooming in on kind of the asset class exposure here. So get rid of the stock index and just look at how we're exposed as a society. 57% exposure to equities at the household level right now. Long-term average 45%. When they tell you that stocks are unloved, that lacks perspective. You can see as well equity exposure or cash exposure 25% as of the end of Q4. The average 32%. Bond exposure, that's really the unloved asset classes. Bonds 18% exposure, long-term average 23%. And interestingly, this data from the Fed actually, it fits pretty well with what we've seen from the monthly survey from the AAII. They're known for their bull bear survey that comes out every week. This is their monthly asset allocation survey, and it tells a similar story as of the end of February. And we'll get March data at the beginning of next week. But at the end of February, stock exposure was above average. Bond and cash exposure were both below average. Interestingly, even through the bear market of last year, equity exposure never dropped below its long-term average. And so you can dismiss what we're seeing from the AI data as well. This is self-reported. Do we really want to trust the feelings of that sample? But it actually jives pretty closely with what we're seeing from the Fed data that goes back longer. Isn't a survey, it's aggregated data. So either way, if we're looking at it from the AI perspective or from the Fed perspective, equity exposure at the household level is elevated, is above average, and has not been below average for a sustained period of time for years. So it's equities that are the most loved asset class at this point. Cash and bonds have been somewhat left for dead in recent years. Another way to look at this is not the equity exposure, but is liquidity. And in this case, as we look at non-equity liquid assets, and I think this is important in this environment, we're kind of treating cash and bonds and money market funds in the same bucket. So it's equities and non-equity exposure. And that's, again, data from the Fed, historically low levels, not where we were at the end of 2021 low, but still well below the long-term average. There's not a lot of cash on the sidelines ready to be put to work into the equity market relative to where the equity market is. So the news out over the past couple of weeks about this surge in money market funds, I think that's one sliver of the data, and it could very well be a reflection of shifts out of, for example, checkable deposits into money market funds as investors move away from savings accounts at banks and into money market funds. But either way, when we aggregate all that non-equity equity liquidity up, the buckets don't matter as much as the fact that in that overall bucket, there's not a lot of liquidity on the sidelines, again, relative to the size of the stock market. What does all that mean? It's great to talk about lack of liquidity. It's great to talk about elevated equity exposure. Well, historically, when you have non-equity assets as a percent of total liquid assets, relatively low, that's the blue line here. Forward returns for the stock market tend to also be relatively low. So that's the orange line is forward returns for the stock market. These are moving the same direction. So when the blue line's moving higher, you have more liquidity. That tends to be followed by better stock market returns. When you have low liquidity, it tends to be followed by poor returns in the stock market. 83% correlation going back to the 50s in this data. Another way we can look at it is equity exposure, stock versus bond exposure at the household level versus forward returns. And here, this is an inverted relationship. So blue line, that's that stock bond ratio peaked at the end of 2021. Equity exposure super high, bond exposure super low. It's come down somewhat. We've gone from 4 times as much equity exposure down to just 3 times as much equity exposure as bond exposure. But still, we're talking about 90th percentile readings when we look over history here. And here, the orange line, notice the axis is inverted. So when the orange line is rising, and that's the correlation with the blue line, when that's rising, that means the forward returns are deteriorating. 88% correlation between these two lines. So when households are, like they are now, heavily tilted towards equities and away from bonds, then you have poor forward returns for the stock market. And so those are long-term positioning things to think about. The question is, what could be the catalyst? These are kind of gone on for a long time. Some of these relationships, what's the catalyst going forward to suggest that there could be a change in behavior, maybe a shift away from equity exposure and towards bond exposure or towards cash exposure? That brings us to 2 things: relative valuations to begin with. Here we're looking at on the bottom, this is a 1-year treasury yield. That's it's a little bit lower than that now, but not much. After volatility the past couple of weeks, it's not quite at 5% anymore. And then the green line, that's the forward earnings yield on the S&P 500. So think of that as the inverse of the forward PE ratio. And on the bottom here, we just have the spread between the two. Historically, you've got about a 3 percentage point spread between the stock forward earnings yield and the 1-year treasury. 1-year treasury yield right now, it's at its lowest level in 20 plus years. So while over the past couple years, that past decade, there's been talk about being no alternative. So we've had to have higher valuations in stocks because there was no competition from bonds. Well, now we are getting competition from bonds in terms of being an alternative to stocks. And so it's no longer that stocks are cheap relative to where bond yields are. Now we're in this environment where bonds are cheap relative to where stocks are trading from a forward earnings perspective. So that's one catalyst, that idea that in the past there wasn't competition for dollars. Now there is. Bonds are offering competition to stocks, and even shorter term, you can actually get some yield on your cash. So that also is a competition for stocks. The other side of this gets back to this interaction between sentiment and positioning is that while moods have soured, we see that all the time about what a bad mood investors are in and how many bears are out there. Like we said, positioning hasn't shifted. And so over time, there's a positive relationship between sentiment and positioning. When investors are optimistic and feeling good, they tend to have more equity exposure. When equity exposure is reduced, they tend to be in bad moods. This is a relationship between the Michigan Consumer Sentiment Index and that AAI asset allocation survey, the equity exposure part of it. And so last year we started to see a shift. Investors were in a bad mood, sentiment deteriorated, positioning didn't. And so rather than moving to the left and down, we just basically saw last year's dots move to the left. And so the question is, do we move back to the right or do we move lower and kind of restore that long-term relationship? My view, when you look at where we are in terms of competition from equities, like we just talked about with bond yields and with cash earning something now, the longer this relationship stays out of whack, the more likely it seems to me that we end up by completing the turn and moving lower in terms of equity exposure. That sets us up well from a long-term perspective. Once we have reduced equity exposure, that's actually a positive going forward. But getting to that reduced equity exposure is likely to involve some volatility on the part of the stock market. And so that's kind of the quick look at this relationship between sentiment and positioning, kind of zooming back, getting some perspective on how households are allocated in this environment. Don't get caught up in day-to-day swings and volatility. Don't get caught up in week-to-week swings in these investor sentiment indexes when we're thinking about long-term prospects for the stock market, when we're thinking about portfolio positioning for the next quarter, next quarters. I think we want to keep the long-term view intact. And the long-term view is that tailwind that we had, that secular tailwind from equities over the past decade, looks like it's run its course. And I think investors would be well suited to think about sideways for longer than maybe people are looking forward to. Continued volatility. The good news is there's opportunities outside of equities to provide some safe harbor. No reason to always be fully invested if the opportunities are not presenting themselves. So that's our market insights piece for this week, March 30th. Hope you enjoyed it. We'll be back next week with our longer portfolio applications conversation where we walk through what changed, what hasn't changed from a month to month, quarter by quarter perspective. So thanks for tuning in. I'll talk to you again next week, everybody.